Okay, so what we're going to talk about today is variable whole life and variable universal life insurance policies. The difference between these policies and like a regular whole life or a regular universal life is that variable products are invested, the cash value asset portion of the insurance is invested in a separate account as opposed to the insurance company's general investment account. So let me break it down a little bit to you so you can understand it, and then we'll get into the mechanics of the program, how it works. So if you get a regular whole life policy through a life insurance carrier, they take your premiums, and then when you get cash value earned back, that cash value can potentially grow more, and that company takes your premiums and invests that into a company's general account. Okay, so a general account will include typically very conservative investments, right? That's why life insurance companies are so old, is because they invest in long-term growth, almost like guaranteed growth assets. So they invest in a lot of bonds, a lot of treasury notes, things that like are going to grow slower, but have some sort of a guarantee, almost like a guarantee to them, like very high quality assets that they're investing in. Now, a variable life or a variable universal life, what that does is it takes the money and it invests it in a separate account. So it takes the say the insured or the policy owner wants to take their cash value in a variable life policy and invest it in a separate account that's based on mutual funds. So you can have it based on things in the stock market that may be more aggressive, they may be riskier, but over time may grow more. It's just year to year, it could fluctuate more, okay? An insurance company that's owned by its policy owners or by stockholders, it doesn't want to take a ton of risk, but an individual can usually afford to do that. Now, a variable life or variable universal life, it's better for younger people. It's the suitability for this product isn't for like older people for the most part, because if you're older and you have money that you want to like conserve in an asset and not take as much risk with, you don't want to invest it in the stock market. You want to have it in things that are a little bit more conservative investments, and a regular whole life would probably make more sense in that sense. But with the variable life and variable universal life, there's a little bit more risk, so you can choose to invest the money from the cash value into a riskier asset. That's really all it is. And when it comes to the product itself, we're going to go to variable life first. So with a variable life policy, it's a level premium and it's a fixed premium. The premium can't change. There is a minimum death benefit, right? Just like any whole life policy, there is a minimum death benefit, but the cash value, like I said, can fluctuate over time. And the risk of the cash value growth is contingent, is all on the policy owner. The insurance company doesn't assume any risk of the cash value growth. The insurance company does assume the risk of the investments when they, in a regular whole life or universal life, when they invest it in their own company account, the general account. So each domestic insurance carrier, if they offer variable life policies, is required to have at least one separate account. A lot of these companies will have a bunch of them. There will be securities that you can invest in, and there will be a bunch of different portfolios that you can choose from and look for. So if you ever go to sell these products, then you will have access to helping people choose which direction that they're going to put their investment in. So they're going to go riskier, they're going to go more conservative, what are they going to invest it in? And then that really is upon you as giving the best advice on what they should do based on their goal and what their risk tolerance is, which is a total other chapter. Suitability is going to be a whole nother video. But suitability really comes into play with variable policies, because you can get yourself into trouble as an agent if you recommend for someone to go and assume a certain risk tolerance who shouldn't really be taking that risk tolerance. So the variable life, like a straight variable life, a variable whole life essentially, it has a minimum death benefit and it has a level fixed premium that's always the same. The only thing that fluctuates in it is the cash value based on where you're investing that money. Now, a variable universal life, it has a lot of the same tenets as a universal life. So it can have different, you can fluctuate on the premium. So you can increase the premium. Remember, on a universal life, you can decide to pay a little more some months. You can pay a little less some months on what your target premium is. There's a minimum premium, which is the minimum just to keep the policy in force in that time. And then there's a target premium, which is the amount that you'd want to put in to keep the policy in force for your entire life, or to whatever date you're trying to keep the policy in force for. So with a variable universal life, you can actually adjust the premium that you're paying up and down. And also, if there's enough money in the cash value, you could even potentially skip a premium payment date. Since the cash value over time for someone younger on these policies can grow pretty aggressively, what some people do is they say, look, by the time I'm age like 65 or 70, as long as it grows as we are predicting, I may not even have to make another payment on this plan after I retire. Now, that is, for me, I am not a registered representative with FINRA. I am not a securities broker, but I just know, like, if someone starts investing at 20 in the stock market, over time, by the time they're 65, they're going to have hopefully, I would imagine, a good amount of money saved up. And if that's in cash value and life insurance, then it may be accumulating enough interest at that point that it's more, the interest it's earning is more than it actually, the premium for the policy. So that's what I'm saying. But that's a totally different thing. Variable life and universal life are regulated by the federal government and by the state government because it's an insurance product that deals in securities. So insurance is regulated by the state. Securities are regulated by the federal government. So the SEC, the Securities and Exchange Commission, and FINRA, the Financial Industry Regulatory Authority, they regulate the securities portion of it, and then the Department of Insurance to that state regulates the insurance portion of it. So variable products are regulated by both the state and the federal government. Now, to sell variable life and variable universal life, you have to be certified as a registered representative with FINRA, and you have to have a securities license. So a securities license is like Series 6, Series 63, Series 7, those licenses, which are above and beyond your life insurance license. They're separate tests. So if you do want to sell securities at some point, you will have to take those separate tests as well. And they are harder than your insurance course, and they are definitely more challenging, and there's a lot to learn. But if you want to get into being a financial advisor, then 100,000% you're going to want to get your securities license because it's going to just open up the different products that you're available to sell to your clients. Someone younger may be looking for more of a risk-based portfolio as opposed to the fixed guarantees. A few takeaways from this that you want to know is that there's a separate account that variable life and variable universal life are invested in. The policy owner bears all the risk of the cash value in the investment. The insurance company doesn't bear any of the risk. To sell variable products, you have to be a registered representative with FINRA, the Financial Industry Regulatory Authority. You have to have a securities license, and you also have to have an insurance license. And these products are regulated on the state level for the insurance portion and on the federal level for the securities portion. Variable life, the premiums never change, and there's a minimum guaranteed death benefit. However, the cash value can fluctuate based on the performance of the separate account that the cash value is invested in. And variable universal life, the premium can increase, the premium can decrease if you'd like. You may be even able to skip a premium payment, and you can take cash value withdrawals and policy loans as well against the cash value. So these are great policies for some aggressive cash value growth over time if some of your clients in the future are looking for that. But the basics that I just covered there are really what you're going to need to know for your insurance license course. Check out some other videos in my channel. I am creating a full curriculum so that you guys can have some other explanations on how these products work. And I wish you the best on passing your insurance license course. If you have any questions, just email me at jve@thejve.com. And also, once you do get your license, you can check out my other channel called Justin Von Eigen, my name. Just check out my channel, it's in my name. And you'll be able to read and watch some videos on how to sell life insurance effectively over the phone. That's exclusively what we do at my agency here. We sell insurance 100% over the phone. So I'm excited for you guys to start your career in the insurance industry. And if you have any questions at all, please reach out.